Welcome to the Continuing Education Program for the participants in the Capital Area Health Consortium. I am Michael Callahan from CCR Wealth Management LLC, and we are investment advisors and have a full staff of certified financial planners to help you. This program will cover student loan repayments. Our agenda for this presentation is as follows. 1. Federal versus private loans. 2. Subsidized versus unsubsidized loans. 3. Repayment options. 4. Consolidation and refinancing. 5. Forgiveness options. 6. Public service loan forgiveness. 7. Examples. 8. Next steps for financial planning. Private loans are an option to cover the costs of education beyond those covered and are available through federal loans. These are provided by banks, credit unions, and other finance companies. These are riskier since they lack some of the protections and flexibility offered by the federal student loans. These are not eligible for forgiveness and not eligible for federally offered repayment plans. The terms of the loans depend upon the lender and promissory notes. These are potentially more expensive depending on the market interest rates and dependent upon the credit scores and debt ratios. Federal student loans, on the other hand, are issued by the U.S. Department of Education and are offered in multiple forms. Interest rates are controlled by federal law, and typically they are lower than private loans. Subsidized loans are available to those with financial need. No interest accrues while in school at least a half a time and during the 6 months grace period or during periods of deferment. This makes these less expensive over time. There is more freedom in an unsubsidized loan, but they are more costly. If additional loans are needed to cover the cost of education, unsubsidized loans are available when financial need is not required. Loans accrue interest immediately even while in school and deferred. Unpaid accumulated interest can capitalize, which ultimately increases the loan balance and payments. Our first repayment option is the traditional repayment method, which amortizes the loan over 10 years. Unless you request otherwise, this will be the repayment plan once repayment begins. Next is the extended repayment method. This recalculates repayment terms up to 25 years. This option is only available for balances greater than $30,000. This method may have a fixed or graduated repayment schedule. This method is not eligible for public service loan forgiveness, PSLF, since it is not based upon income. The graduated repayment method allows for payments to increase over time as income likely increases. Payments increase every 2 years and the loan is paid off within 10 years. Income-driven repayment plans. There are several income-driven repayment plans. They are the newly established repayment plan, SAVE, which is Savings on a Valuable Education, which was formerly known as the Repay plan. Anyone previously on the Repay plan will automatically be switched to the SAVE plan. The Pay plan is Pay-as-you-earn plan, and some older options, IBR, Income-Based Retirement Plan, or ICR, Income Contingent Plan. Each plan has a specific formula for determining your income-based repayments. Your payment calculation depends upon the combination of percentage of discretionary income, your family size, the state poverty income level, the maximum payment allowed under the plan, years to long-term forgiveness, tax filing status of married filing jointly or married filing separately, how interest accrues, and interest capitalization limits. Let's look at the comparison of the various repayment options. Under the newly designed Savings on Valuable Education Plan, or SAVE, the payments are as a percentage of discretionary income, which is currently 10% for undergraduate loans. However, as part of this new repayment program, after July 2024, the calculation will use 5% of discretionary income for undergrads. The percentage of discretionary income for graduate loans will stay at 10%. Other features of this plan include the ability to reach long-term forgiveness in 10 years for balances under $12,000, with that time frame lengthening an additional year for each additional $1,000 in loan that you have in the balance. The maximum time frame until long-term forgiveness is complete is 20 years for undergraduate loans and 25 years for graduate loans. Unlike other repayment plans, unpaid interest will not accrue in situations where the income-driven payment is lower than the interest charge. This new payment plan is seen as a benefit for those looking to reduce their payments for affordability, reach long-term forgiveness goals, and do a public service loan forgiveness. Under Pay-As-You-Earn plan, or Payee, the payment is 10% of the discretionary income using a standard 10% of discretionary income, which has a maximum term loan of 20 years, and interest can be capitalized up to 10% of the principal. Under the income-based repayment plan, payment as a percent of discretionary income is 10% for years after 2014 and 15% for years prior to 2015. The payment maximum is the standard 10-year payment amount. The maximum term is 20 years after 2014 and 25 years for years prior to 2015. Interest capitalizes if you leave this repayment method. Lastly, under the income contingent method, payment as a percentage of discretionary income is 25% and the payment maximum is over 12 years. Maximum time for long-term forgiveness is 25 years and interest can be capitalized up to 10% of principal each year. The other payment plans are typically going to yield a higher monthly payment and unfavorable interest terms. However, it can be helpful to compare the potential payments and loan balances with unique circumstances. For example, payment plans will look at married couple incomes dependent upon their tax filing status. Some may have a portion out of their payment responsibility differently if there are imbalances in income and loan balances. Outstanding loans can be consolidated where the consolidated loan is paid between 10 and 30 years, depending on the balance level. If the debtor wishes to consolidate the loans, there are some advantages and disadvantages. For advantages, the debtor may have a lower payment with a longer term, or have a simpler method to repay loans in one payment rather than multiple payments, or have more repayment options available if they previously held a loan type ineligible for certain repayment options. And they can include defaulted or delinquent loans, which could remedy the situation. Disadvantage includes interest rates may increase with a weighted average interest rate that is rounded up. There may be an increased interest cost with a longer term. There is a loss of flexibility of debt repayment. By keeping the loans separate, this can allow the borrower to focus on paying higher interest rate loans first or smaller balance loans more aggressively over a period of time. And consolidating restarts the clock towards forgiveness. While this isn't a likely option in today's interest rate environment, let's look at the advantages and disadvantages for debtors that may want to refinance. For advantages, the debtor may experience the following. They may have lower interest rates, may reduce payments by lower interest rate and longer terms, can refinance as often as the borrower likes, and this is a method of consolidating certain loans into one with a private refinance loan. The disadvantages for refinancing are they're no longer eligible for federally offered repayment plans, they're no longer eligible for potential forgiveness, and there may be strict underwriting depending upon the lender. Making greater than the minimum payments can minimize overall costs of the student loans. Overall payment can be done in a periodic lump sum amounts or additional monthly payments. There are various strategies to consider. The debtor can prioritize high interest rate loans and keep lower interest rate loans at a minimum payment. We can look at two methods for greater repayments. The first is called the snowball method, where the debtor pays off smaller balances first. The advantages of this approach are it's satisfying for the debtor to pay off debt quickly and it keeps the debtor motivated. The disadvantage to this approach is it pays more interest over time compared to the avalanche method. All in all, both will reduce the interest paid over time to some degree. The second method is referred to as the avalanche method. Here, the debtor will focus additional payments to pay off the highest interest rate loans first. The advantage is that it saves more interest over time, but the disadvantage is that it may be less motivating for the debtor because it takes longer to pay off. There are three basic forgiveness options. They are discharged loans, long-term forgiveness, and public service loan forgiveness, PSLF. Discharged loans are not very common and usually the result of an unfortunate event. These are situations where, at no fault of the borrower, the education they received lost significant value for some reason related to the school or fraud such as student loans from a school that unexpectedly closed or lost its certification. Other unfortunate ways to have your federal student loans discharged include total and permanent disability or if you die. A parent's loan can be discharged at a student's death, however, not necessarily if the parent dies and there is a spouse as a cosigner. Long-term forgiveness is available for the income-driven repayment plans. This would be most relevant and beneficial for borrowers with a high loan balance and relatively low income levels. If there is a balance remaining after the maximum term is reached under the income-driven repayments, the balance will be forgiven. It's important to plan that the amount forgiven may be considered as taxable income for federal income tax and possibly for state income tax purposes based upon the specific state tax provisions. Depending upon the balance, the specific payment plan, and whether interest has accrued, this can be significant and often an unexpected expense of long-term forgiveness. The American Rescue Plan of 2021 modified the treatment of student loan forgiveness for discharges in 2021 through 2025 to not be considering income for tax purposes. This applies for federal income tax only, and each state may vary. For example, Massachusetts follows the federal tax definition for loan discharges. Therefore, if the debt is not taxable at the federal level, it will not be at the state level as well. Yet each state may differ. As the law stands right now, after 2025, discharged debt will again be considered taxable income. Public service loan forgiveness is a separate program we will look at more closely on the next slide. Yet per the IRS, student loan balances forgiven under the PSLF are not considered income for federal tax purposes. Public service loan forgiveness are for those borrowers who work for a nonprofit 501c3 or other not-for-profit organization, a government organization such as a state, local, or federal agency, or full-time for AmeriCorps. Work must be on a full-time basis with a qualifying employer while qualifying payments are being made during the application process and still at the time of forgiveness. Forgiven loan balances will not be included in taxable income. Payments must be made over 10 years to achieve forgiveness. 120 qualifying payments must be made under an income-based repayment plan. Some tips. The administrative process can be difficult as many loan services are understaffed and ill-prepared for processing forgiveness and changes to student loan procedures. To best navigate the process, you should annually submit the PSLF employment certification form and strive for the lowest IDR plan payment to minimize cost. Let's look at an example. Assuming that the following information for the borrower is here. The annual income for this borrower is $80,000, yet they are reducing their taxable income with group health insurance deductions, as well as retirement plan contributions, such as a 403b contribution. We are assuming this borrower lives in Connecticut and is single with no dependents. The current undergraduate loan balance is $140,000, with an average interest rate of 5.9%. We are assuming the borrower is in a 22% tax bracket with a 5% state income tax. This borrower does not work for a qualifying employer for public service loan forgiveness. We are assuming 5% inflation on the income. Given those assumptions, let's look at how the different payment plans will affect the payment strategy. Under the SAVE repayment plan, the monthly payment would be $335 a month. As the income inflates over time, there is a recertified payments, and they will increase to $639 a month. Under this income-driven repayment plan, the maximum period is 20 years, at which time the remaining balance, projected to be $139,732, will be forgiven. The total payments made under the 20-year time period is $113,290. This is an example of a payment that is barely covering the interest portion of the payment and therefore does very little to reduce the balance over time. This scenario would need to account for a potential income tax bill as the forgiven amount will be taxed as income, possibly increasing the borrower's tax bracket. The standard repayment plan is also listed for comparison. This is the traditional payment plan where the loan is amortized over 10 years with a steady payment until it's paid off. If the payments are affordable from a cash flow perspective, this may or may not be the most costly over time compared to the SAVE plan, depending on the tax implications of the loan forgiveness. The extended repayment plan shows how extending the length of the loan can increase the overall costs over time. While this may help reduce payments to make them more affordable, there are long-term costs as seen in the total paid amount over the 25-year period. With each of these plans, there is always the option to overpay either monthly or in a lump sum. While this would not be advantageous if the goal was long-term forgiveness, this would reduce the total paid for the non-income driven repayment plans by paying the debt off sooner. Let's look at another example of someone married who is an employee of a qualifying employer for public service loan forgiveness. Assume the following. The annual income for this borrower is $160,000 and their spouse is $75,000. They are reducing their taxable income with group health insurance deductions as well as retirement plan contributions. We're assuming this borrower lives in Connecticut and is married filing separately with 2 dependents. The current loan balance is $115,000 with an average interest rate of 5.9%, and his spouse has some loans as well. We are assuming the borrower is in the 22% tax bracket with a 5% state income tax. We are also assuming 5% inflation on income. Given those assumptions, let's look at how the different payment plans will affect the payment strategy. Under the SAVE repayment plan, the monthly payment would be based on the primary borrower's income alone and range from $771 to $1,373 per month. To qualify for the public service loan forgiveness, 120 payments need to be made, which, when done consecutively, will be 10 years, and at which time the remaining balances is projected to be $41,965, and that amount will be forgiven. The total payments under that 10-year time period is $125,983. The payee repayment plan is also compared. While the initial monthly payment is higher, as income grows and calculated payments grow, the monthly payment is capped at the 10-year payment level. While this plan still leads to forgiveness, the SAVE program is a better choice here. The standard repayment plan is also listed for comparison. This is the traditional payment plan where the loan is amortized over 10 years with steady payments until it's paid off. Keep in mind for this scenario, if the couple were to complete their taxes as a married filing jointly, their income level would increase their monthly payment. In each of the income-based repayment methods, the calculated payments would have the loan paid off within the 10-year time period, leaving nothing to be forgiven. Therefore, depending upon other tax implications, the married filed singly is more beneficial in reaching public service loan forgiveness than the married filing jointly in this example. Strategizing student loans is one piece of a bigger financial planning puzzle. Often student loan borrowers have additional financial goals which need to be balanced with paying off their student loans. You might want to have an emergency fund, managing other debt outside of student loans, managing a budget, saving for retirement, or a future purchase of your home, as well as making sure you are properly protected with disability and life insurance. Thank you for viewing this presentation and listening in, and we hope that you take us up on our offer for a financial plan. You can work on your repayment process as well as your other financial goals. We wish you well.